Hey everybody, just wanted to go over really quickly with you what a lot of people are getting wrong in the media and why they're wrong. So I've been hearing a lot about inflation ticking up, and as a result of the inflation ticking up, mortgage rates are going to go up. That's what a lot of people have been saying, but that is not at all what we're expecting. And so I wanted to kind of go over the expectation and what's really going on right now to sort of set the record straight on it. So rates have been going down. They've been going down nicely, and a big part of that is the labor market. The labor market's very weak. It's been showing a huge sign of weakness. There have been huge job discrepancies, and a lot of the numbers that have been reported before have been adjusted down by like I think over the past year or so. I think it's like 900,000 jobs that they said were created that actually were not created, and unemployment has been ticking up. They're actually expecting it to go from where it was 4.1%, might hit 4.5% by the end of the year. So these are the things that are causing the rates to come down because a weakened job market and a higher unemployment rate means that means that you know interest rate cuts are likely, and the reason is because that shows a weakening economy and heading toward a recession more and more, and recessionary trends are really good for mortgage rates. Maybe not bad for other parts of the country, certainly, or industry, things like that, but it is good for mortgage rates, and so that's what we're really seeing. We're not expecting the inflation to sort of overlook that. There is a balancing act that the Fed is attempting right now, which is, they do have inflation ticking up at the same time unemployment and job creation looks bad, and so as a result they have to try to figure out, okay, how much do we cut, because we don't want it to make inflation worse, but at the same time we don't want the job market to keep getting worse because that's terrible for the economy. And so anyway, one thing that we are thinking is that the Fed has sort of mentioned this before, and that is that inflation ticking up could be getting caused by the tariffs that are finally starting to hit home and causing the inflation to tick up. But the Fed has also said that they believe that the inflation ticking up due to tariffs would be a temporary setback on inflation because it's considered a sort of a one-time adjustment rather than persistent inflation that keeps rising. So anyway, that's kind of what we have going on right now. So I'm going to share a screen with you really quickly. Also keep in mind, the reason I'm going over this now is because the Fed is meeting this week, and then they will have results of their meeting and a press conference on Wednesday, like 2 or 2:30ish Wednesday, and they'll go over that. And what's really going to make the biggest impact on mortgage rates going forward is going to be not what they do as far as cuts, but what they say after the meeting, because we kind of already know what they're going to cut at this point for this meeting. They're going to make a 25 basis point cut. There's like a 4% chance that they might go 50 basis points, but it's like 96% is going to be like 25 basis points. So that's what we know is going to happen, but that rate cut is already priced into the market. And so we believe that what's really going to make the difference is what Powell says at the press conference after their meeting, because what his comments are is going to kind of give us a picture as what we're expecting the Fed to do moving forward for the remainder of the year, and if we expect them to make more cuts. And that's kind of the key. So I'm going to go ahead and share a screen here real quick. All right, you should be able to see my screen coming up right now. And this is the 30-year mortgage bonds. As the mortgage bond goes up, rates come down. And so you see we've been in this range for the past, six business days, right in this range between these two lines. This is a line of resistance at the top, and this is a floor of support at the bottom. And that's why we're between these. Now, whether we break above this or break below this line is going to depend on Powell's comments. If he's extremely hard to read, then we may continue to trade in this range for a while. However, if we can get a read on what he says, if he's talking more about the struggles of the labor market and that they're very concerned about it and all this kind of stuff, that's going to lead the market to believe he's going to make more cuts, or the Fed's going to make more cuts by the end of the year. If he talks more about being very concerned about inflation ticking up and that they're worried it might be persistent, which I don't really expect him to do, then if that happens, they're more likely to break below this. We want him to break above, right? So we want his comments to be, okay, the employment situation is a real problem. That's what we're concerned about. And if that's the case, then we're going to see this move higher and move above this line. That's what we want. That means more, the rate coming down more in the future. I've had a couple of people lock recently at 5.69 and 5.75, right in that range. I could see these rates getting down to 5.5 or below within the next month or two if his comments come out well, kind of where we expect him to be. So that's kind of what we're expecting at this point. It really comes down to his comments. The other part of this too is that there are Fed members who in the last meeting thought they should have cut, and I believe that there are more on board now, and as a result, I think that they're going to. My belief is that this year, they're going to make this cut in September, 25 basis points. I believe they'll make 2 more 25 basis point cuts by the end of the year. And if they do sort of signal that, that's going to allow rates to move lower and this bond is going to go higher. And so that's kind of what we're looking at right now and what we're kind of expecting. But just wanted to cover that a little bit here because Fed Week is always a big week in the mortgage industry. One thing about it is the Fed funds rate doesn't impact mortgage rates directly, but they always have an impact indirectly over time. So like last year, they made 3 rate cuts. In the first rate cut, we did see the rates move lower, but the rates actually moved higher during the second 2. The reason the rates moved higher during the second 2 was because we got these big jobs report numbers that were actually false. And so the job reports came in showing that we had 230,000 job creations and stuff like that. It happened a couple of times. And whenever that happened, that's why the rates went up even though the Fed cut. And so anyway, we figured out later that a lot of those jobs they said were created were not created because they adjusted them down. But they still had their impact at the time because when this data comes out, the market assumes it's correct or close to correct. And it's been so far off over the last year that it's really causing an issue. So that's kind of what we're looking at now. If you look at over time, there's a chart, I don't have it in front of me right now, but there's a chart that shows over time when the Fed makes rate cuts and what mortgage rates do. And they go pretty closely, together. As the Fed cuts rates, you'll see within a short period of time, mortgage rates go down in most cases. And so even though there's not a direct impact, there's almost always an indirect impact. And so if the Fed does cut rates this year, unless we get some bad, some really false job numbers again, this year, unless that happens, we're going to see rates continue to fall. And probably within the next 6 months, we could potentially see rates drop under 5%. And that would be incredible if that happened. That would mean we're definitely in a more of a refi boom, because I know people who locked their interest rate between 6.5% and 7.75% at different points in time. And all of those people would want to refinance once we get down under the 5% mark. So anyway, that's pretty much it. That's what I wanted to cover. If you do have any questions or anything, or want to reach out to me, or you'd like to get pre-qualified to be ready to refinance, depending on what happens here, then certainly reach out and let me know. I'm always here to help. Thanks.